Hello everyone. Today we're going to talk about the stock market of the United States, and I'll split this analysis into two videos. In one, we'll look at the Dow Jones Index as one of the most important indices of the US stock market. In the second video, we'll discuss the S&P 500 index, which is the most comprehensive among the top American indices. Let me remind you that we conduct our reviews on the QuantFury platform. Here you can trade not only cryptocurrencies, but also stock market instruments, ETFs, and so on, including the Forex market. I also want to draw your attention to the fact that when we analyze the crypto market, and Bitcoin in particular, we must always take into account the situation in the stock market, because the stock market is the foundation, the basis. And if we see a very sharp decline in the US stock market, then with a high probability the cryptocurrency market will follow in the same direction, because one way or another, it is a market of much riskier financial instruments. Now let's switch to the S&P 500 chart, or rather, yes, the S&P 500 in this case. And right now we have the SPDR S&P 500. This is an ETF fund based on the index itself. Right now, as you can see, the sell and buy buttons are grayed out. Why? Because the American stock market session hasn't started yet. It will start in about an hour and 20 minutes. That's it. But that doesn't stop us from doing an analysis. If we enter the index volume directly in the search bar, those will be the futures and minis that are traded on the Chicago Mercantile Exchange. They are traded basically around the clock except on Saturdays and Sundays. And here you can see the index value, but this isn't during the American session. 6,545 points, right? So it's not expressed in dollars, but in points, although trading is often tied to the dollar. So 6,545 and 650 differ exactly by a factor of 10. That is, by multiplying by 10, we get the index value. But here we have a continuous chart. If you know futures are traded from one date, from the opening date to the expiration date, and that's why it's more convenient to do analysis on a continuous chart. Now let's pay attention. Here we have monthly candles, the most global ones. Let's focus on the following points. Look, here's a very interesting episode on the chart. Two consecutive highs, one significantly lower than the other. At the same time, if we zoom in on the chart and look at the price highs, here's one, and here's the second, right? The price highs are rising, but there's a significant drop in the highs of the RSI indicator. This indicated a high risk of decline, right? And here on this candle, at its close, or roughly from its middle, well, let me zoom in even more so it's perfectly clear. From its middle, you could, well, why from the middle? Because, as a rule, there's usually some pullback either to the middle of the red candle or to its base. The same logic applies in the opposite direction as well for candles. Here we got roughly to the middle of the candle's body, and then there was a very deep decline, right? So let's say the red candle closed at a level, we'll always multiply by 10, okay? 2,700 points. And it dropped to the lows, which are 2,340 points. Well, as you can see, the decline is significant. Let's calculate it as a percentage, but only using tools, not just, well, 13%, right? And that's after this candle from October 2018 already showed a very significant drop on its own. So I'm just describing this to you as a model of a pronounced divergence. RSI is in the overbought zone, there's divergence, and then a pronounced divergence followed by a decline. Notice that the new high, followed by a reversal right here, was reached at significantly lower RSI values, which in itself indicated that the market was running out of steam, that it was running out of fuel for this growth, and as a result, we saw an even deeper decline. So here you go, this is how the situation unfolded. Now we can't see the part of the chart that's above right now, but we can see that there are also signs of divergence here, right? You see, we have two bends, two consecutive highs with a decline, one after the other. Now let's look at how the price behaved during this period. Look, here we have a price high in one place and a price high in another place, right? And we get a rather deep correction on the very first candle, which moreover also formed a bearish engulfing pattern on the monthly time frame. The drop from the closing price of the red candle ended up being 21%. That's quite a lot as well. Well, we can leave it at that. Now we've taken all this information into account. And now, let's reason it out. Look, here we have one high, right? Well, here's the high zone, and here's the corresponding zone on the RSI. Now we already have a zone of even higher highs. And the RSI, let's expand it to full screen now. The RSI is at a much lower level, that's obvious. But we don't have the right to say that this is a short here. That right won't appear for at least another month, right? Why? Because we have to... What do we need to see in order to consider a short? We need to see a break like this. That is, we need to see that the RSI has also started to turn downward, right? And in addition, it's highly desirable to see a bearish engulfing pattern on the monthly time frame. But look here, there was no engulfing pattern. It was not possible to take a short. But here there was an engulfing pattern. One bearish candle engulfed, well, almost 3 bullish candles. Accordingly, there was also an engulfing pattern here, right? But it happened, well, it actually occurred on the second candle, but nevertheless it was there. There was also an engulfing pattern here. That's why we wait for a bearish engulfing and then open a short. Well, again, with a stop order, I want to emphasize that the market is a very, let's say, volatile thing, and where a short might seem obvious, the trend could actually continue. What would I do here and now, at this moment? I would wait. From the point of view of at least the monthly candles, now let's look at the weekly ones. What I definitely wouldn't do is buy, because buying in this area carries huge risks. What could happen? There could be further growth and it could go much higher. I have no idea how far. That is, since we're already at historical highs, it's very difficult to estimate how high the market can go. But in the current situation, where a monthly scale divergence is forming, or at least the prerequisites for it are there, I definitely wouldn't buy. I would only buy after a correction, only after a correction. Right now to buy... Sorry, let me mute the sound. Right now to buy the S&P 500 index, well, you have to be a very confident and very well-informed person, someone who knows the internal makeup of traders' orders. I don't have that kind of information, so here it's just a matter of waiting for a short entry point. Now we remove absolutely all the drawing tools we've used and look at the similar pattern on the weekly time frame. There is absolutely nothing here indicating a decline. In my opinion, shorting a market like this is not the right move, right? And buying in the current market condition is, well, quite risky. That's all I can say. But I want to draw your attention to the following point. Look, here the market moved towards the 200-week moving average. Then it went up somewhere towards the 50-week and the 100-week moving averages. Here, it only reached the 100-week moving average. It didn't get to the 200-week. That's why we have a good chance over time to see not only a move towards the 200-week moving average around 4,150 points, but also a break below this average, yes, with a significant drop beneath it. But for now, it's too early to talk about that. Those are prospects for some time in the future. Let's take a look at the daily candles, and we'll wrap up our review there. What do we see on the daily candles? And on the daily candles, we see a rather grim picture. What does it look like? Well, it's the same as before. Look, one high, a second high, a third high, a fourth high. 4 consecutively lower highs. If we shift these highs, well, if we mark the corresponding price highs, then look, here is one price high, right? And the RSI high. Here is the second RSI high. Here's the third RSI high. And now there's some kind of fourth one. So in fact, we have 1, 2, a triple divergence. But here the same rule applies. Until we see a bearish engulfing pattern, until we see the RSI breaking downward, we have no right to talk about shorting. This upward movement may continue. The RSI can go significantly higher, it can enter this zone. But that's just speculation. I would put it this way. First point, in my view, based on how I analyze charts, this is a pre-short situation. Then the second point, well, let's at least draw some kind of level. First of all, we had, well, I don't really like to draw levels from red candles, but let's take it into account anyway. First, the drop started from this level, and second, the upward movement stopped at this green level. Yes, at the green candle. After that, we only had red candles. And finally, there was this green growth candle, where we also, well, I would even mark this one, yes, the previous high. So as long as we are trading above 6,480 points, again, there can be no shorts. That is a close below 6,480, a break on the RSI, then you can consider a short. And for now it's growth. At the moment, the chart is showing growth, and there is not a single reason to go short. Subscribe to the channel and leave your comments. I'll just add that the growth in the S&P 500 index keeps the window of opportunity open for the cryptocurrency market to grow. As long as there is no reversal here, the cryptocurrency market can continue to rise. When the stock market starts to decline actively, the cryptocurrency market has almost no chance to grow. Subscribe. Goodbye.